بسم الله الرحمن الرحيم الحمد لله رب العالمين اللهم صل وسلم وبارك على محمد وعلى آله وصحبه أجمعين. اللهم نور قلوبنا بالعلم وزين أخلاقنا بالحلم وافتح بيننا وبين قومنا بالحق وأنت خير الفاتحين. ثم أما بعد. السلام عليكم ورحمة الله وبركاته all, and welcome to Guidance College. Welcome to this seminar, this webinar about Islamic Mutual Fund in the US. Just to give you some background, this is an academic actually class, one of the lectures of a course called Islamic Finance Contracts, in which our graduate students at the Executive Masters in Islamic Finance at Alqudah University or Guidance College are exposed to different contracts, different Islamic modes of finance for different Islamic mortgage companies in the US. So far we did discuss the different modes of finance of La Riba, of Devon Bank, of University Islamic Financial, and of Ijara Loan. Next week, inshallah, we will be discussing the model of Guidance Residential, and the CEO and some other top executives in Guidance Residential, inshallah, will be joining us to educate us more about the model of Guidance Residential, what kind of mode of finance they have, how did they approve this mode of finance, how can they make sure that their practice is Sharia compliant enough. As of today, it's my pleasure actually to introduce to you my friend and my colleague, Dr. Mohamad Nasir. He is the general manager of Iman Fund. Iman Fund actually is one of the well-known and well-established Islamic mutual funds in the US. A part of this class actually is to diversify our experience and not to focus only on Islamic mortgage companies. Because when we talk about contracts from a fiqh perspective, we are not limited to mortgage industry. We have several, various Islamic contracts conducted and operated in the US. Mortgage companies actually is one branch, is one industry. But we do have another actually major and significant influential industry, that is the mutual fund. Maybe you all know that opening a saving account is not an option for practicing Muslims. Opening a saving account is not an option because the Islamic interpretation of a saving account is that you as an investor, you lend your money to the bank. This is the fiqh interpretation of the transaction, because your principal and your profits both actually are guaranteed by the bank, which is something in a very clear contradiction with the Islamic principles. As you all know, when it comes to investment and business, you cannot guarantee your principal, leave aside to guarantee your profit. So for those who are looking for Islamic alternative for opening a saving account, those who have some savings, some reserve, and they want to set off the inflation of the money, they want to secure at least 2.5% for the zakat that they want to pay every single year, it is actually a good option for them to consider Islamic mutual fund in the US. Of course, we have several companies, alhamdulillah, but again, as I said in the beginning, one of the most advanced, one of the well-established, well-known Islamic mutual fund is Iman Fund. And I'm glad to have Dr. Mohamad Nasir, the general manager, to introduce us to this company and to the industry at large, Islamic mutual fund in the US. How can we benefit? How can we take advantage of those institutes and put our financial resources together for a win-win situation? So with no further ado, Dr. Mohamad Nasir, the floor is yours.
Thank you very much. So everything is good. It can be heard. The sound is good.
Yes.
Inshallah. And thank you very much, Sheikh Dr. Iman Alqudah, for this opportunity and for the work you are doing on behalf of the Muslims in Alqudah University, Guidance University. And I'd like to thank all the participants for coming in this evening to explore the investment side of the Halal Islamic finance industry. So to begin, I just want to make sure that I can get. So again, my name is Mohamad Nasir. I work for Allied Asset Advisors. As you can see on that first page, you'll see the name of the company on the top, and then there's Iman Fund, which is the name of the fund itself, and then the ticker symbol. The ticker symbol is IMANX, and if you were to go to a third-party website and you put that name, that ticker, that symbol, you'll be able to get information on our fund, and inshallah we'll go through that in details. So let's go to the next part. So we are a mutual fund. Mutual funds are investment pools that pool money together for investors to purchase shares in a collection of securities of different funds. And those securities would be called a portfolio. So the mutual fund has a portfolio, which is a list of securities that people buy, which the investors buy. And there's a portfolio manager that manages that. So basically, the mutual fund is a entity that buys, in our case, equities, stocks, and companies, and the owners of that fund are the shareholders, and they're owned by pro rata, which means if 10 people had put in $1,000 each, and if the pool is 10,000, and the 10,000 was bought into the equities, those 10 individuals would own 10% of all the stocks. And this occurred, alhamdulillah, because this gives the small investor, the retail investor, people who are average people, the opportunity to invest in the stock market. In the past, before the mutual fund industry was created, people, if you wanted to buy a company, you would have to buy a company directly. So if you wanted to buy, Google was not around, or Amazon at the time in the early 20th century. But let's say an example would be Amazon, which is about $1,500 today, and you're a small investor. You just got employed, and you want to put money away into a investment. You would have to have $1,500 to buy just one stock, and that would be high risk. You had no diversity. There was a huge risk factor. So the mutual fund industry was created to give that small investor an ability to buy what other rich, well-to-do people have that opportunity, which is to diversify their investments, be able to buy multiple stocks and companies. So, for example, in our mutual fund, we have 100 companies. So when you buy, and the minimum to purchase is $250. So in your $250 purchase, you'll be able to own a fraction of 100 different companies. And this way, you have that diversity, and you're able to participate in the stock market and all the benefits that come from owning companies on the exchange. So the mutual fund in itself is just a pool of money that is owned by the the shareholders, an exact percentage of the money they have in there. So that they own, and it's a separate entity, so they own whatever fund there is. So there are two types. So hopefully that is just to clarify what a mutual fund is. There are two types of mutual funds. One is a closed-end mutual fund, and one is a closed-end fund, and one is an open fund. And Iman Fund is an open fund, which means people can buy and sell over time. We've been around since 2000. So if you bought in 2000 with us, and you sold in 2002, and then bought again in 2005, and then sold again in 2010. New people came in, old people left. So the fund is open, and it continues to buy and sell as the investor would like. A closed-end fund has different guidelines, and we will not cover it, but I just want you to be aware that there is something closed-end fund, which is basically has a time when you're able to buy in, and then there'll be a date when it ends. So it'll be closed. So basically you cannot trade it, and it's not available at any time. It's just a one-time, they give you a window of opportunity to buy in, and then a window of opportunity to sell. So what we're going to be concentrating on is the open mutual fund, which is what we are and what most mutual funds are. And they are available for the retail investor. Retail means in the investment world, there's something called accredited investors and non-accredited investors, and mutual funds are available to all of us. Accredited investor has certain guidelines and law and rules as to who can, so let's say I want to open and ask for investment. from individuals. If I'm not registered by the SEC, which is what we are, we will have to have certain criteria as to who we can solicit for funds. So those types of funds have to have accredited. There's usually a minimum of income level, let's say $250,000 a year of income. They have to have a net worth of $1 million or $2 million. There are certain limitations for the accredited investors, and those we will not cover as well. So the mutual fund that we're discussing is for all individuals, basically any person residing in the United States over the age of 18 is able to invest in a mutual fund, invest, for example, in our fund or any other fund that is considered a mutual fund. So I just want to make sure that we just touch a little bit about something called accredited investors and non-accredited investors. Moving along, inshallah, we will talk a little bit about what is a mutual fund. When I, as the Iman Fund, as the Allied Asset Advisors, approach a investor, I need to make sure that we are able to give them material to read before they are able to invest. This is by law. They have to be aware of what the risks are for their investment. In the mutual fund, we have documents like, for example, prospectus, statement of additional information, annual report, applications, and I'll show you an example of that, summary prospectus, summary annual report, IRA disclosures, and fact sheet. Each of these items are requirements for the investor has when they invest in the mutual fund. It's a way for them to be aware. So, when you say when you buy something in the old days, it used to be buyers aware, and you have to be careful of what you're buying. An investment, this is hard-earned money. People worked hard for their money. This is their life savings for retirement, for some future endeavor they might have. So they have to have some form of comfort as to what they're investing in. So they're not shocked one day when things don't work out the way they're supposed to. So I'm going to talk about the prospectus. The prospectus gives each mutual fund, and prospectuses are common across different investment vehicles. So this is a very common name as a prospectus, which is basically the legal information that you receive from a company that's looking for you to invest in it. So the prospectus is a legal document. It will have criteria that the government requires us to have in our prospectus. So it'll have a summary section, investment objectives and strategies, management of the fund, calculating share price, and we'll go over that in the prospectus, inshallah. So here's I just took out a section of the prospectus, and it says the principal investment strategy. So in the prospectus, it will ask, we have to, as a mutual fund, declare what is our investment strategy. Basically, what are we doing with this money that we're receiving? And in our case, we are an Islamic principled financial institution. So we have, as you can see, the prospectus will say the fund seeks to achieve an investment objective by investing in common stocks and equity-related securities. So it's in common stocks and equities. So this is what we're doing and buying for domestic and foreign insurers that meet Islamic principles. So we're saying to the SEC and to all the investors that this is what we plan on doing with our investment, is to follow Islamic principles. The second paragraph, you'll see on the page after that. Now, sometimes the money is held in a money market, or like Dr. Alqudah mentioned just now, in a savings account, which is forbidden because of the interest. So many times mutual funds will hold money in an interest-bearing account because it's making money. In our case, we forbid the fund from having any money in this interest-based account. So it has to be either in cash or invested in the stock market. So in the prospectus, we'll go over a little bit. If I can get the share, let's see, I can stop sharing here. I'm going to show you the document itself and of the prospectus. This is the application, statutory prospectus right there. So this is what a prospectus would look like. So the first page, the cover page, And as it scrolls down, you can see it has the prospectus, the date. So this was issued September 28th, 2018. So every year this will come out. This is the ticker symbol. This symbol is what was the criteria for our fund. Every fund has a unique symbol. So we'll go to the content, and as you can see, that's what we went over in that previous slide. There's different categories, and we'll just highlight. We'll go through them fairly quickly for time purposes. So there's an investment objective, and then the first thing, obviously, is a summary section. So the investment objective is the fund seeks growth of capital while adhering to Islamic principles. So we're declaring to the government, to the SEC, and to the retailers, the people out there, that our goal, our objective is to seek growth, to bring capital, to increase your wealth, based on and adhering to Islamic principles. So what are the fees with mutual funds? There's different types of fees. So we're going to go into really quickly into this part. So the fees. There are two different types of fees associated with mutual funds. There's shareholder fees, which are fees directly from your investment, and we're considered a no-load fund. In today's world, I think most mutual funds that you'll see are no-load, but if you were an investor maybe 10, 15 years ago, 20 years ago for sure, there were some sales fees associated with the fund. These fees for us there is none. They even if they were, I believe that there's Islamically speaking, they would not be haram, but that's something that maybe can be looked at separately. But for all practical purposes, there are very few companies that have fees right now in this fees. Basically, what it means, there used to be a 5% sales commission to the company that sold the mutual fund. So if you invested $100, $5 of the 100 went to the company as a way to pay for their commission, and then your investment would start $95. And obviously, from day one, you have just lost 5% of your income. I mean, 5% of your asset. Currently, most mutual funds operate with no load, none of these fees, but they do have what they call operating and annual fund expenses. In our fund, we have a total of 1.33%. These expenses come out of the value of the investment, which means that even each day it's calculated and it's deducted from the net asset value. And actually, you don't see it on your statement. So if you receive a statement every quarter, or every quarter we send out a statement, these fees will be already deducted from the price of the share. So these fees of 1% and the 0.33%, they are not. You actually don't see it on your statements. It's deducted automatically. So what are these fees? The management fee, the 1%, which we will cover, goes to the management fee. Basically goes to our company, Allied Asset Advisors. This is the fee that we would receive from the fund to manage the fund. And then there's other expenses, 0.33%, which covers the expenses of the fund. So for a total, the fund fees are 1.33%. And then if you go through the whole prospectus, it gives you a lot of information regarding the company. It gives you information, everything you need to know about the company. I'm just going to stop here for a little bit on performance. So the performance, it gives you also the performance. It can go back 10 years. So in our case, this is what we have to report. So this mutual funds, since we're looking for growth, our fund can go up and it can go down. You can lose money. So if you're $1,000 or $10,000, it would lose or gain. So in 2008, the fund lost minus 40%. So that's a huge drop in the market. The whole market lost money. So there was a loss in 2008. In 2009, alhamdulillah, went back up 34%, and then 15% on the following year. And as you can see, this is the performance. It fluctuates from year to year, so it's not fixed. So this is pure, depending on how the companies are doing is what the performance. So I'm going to skip now to go back to the presentation.
You may verify, Dr. Mohamad, whether the 1.33% is it deducted from the net amount invested by your customer, or from the principal
Yes.
plus profit? Let's say, for
Okay,
example,
so
that
every
I invested
day,
$100.
yeah, so every day the
Go on.
mhm. So if you invested $1,000 on, let's say on Monday, you buy $1,000 on Monday, and the share price is $13. So you would receive $1,000 divided by $13 would be the number of shares you have. Let's say for mathematical purposes, it's 80 shares. You would receive 80 shares at $13. The next day, we would calculate on Tuesday. We would calculate the NAV again. When we calculate the NAV on the second day, the share price will be calculated based on the companies we own, and it will be deducted a pro rata amount of the expenses, the 1.33%. So let's say the market did absolutely no change. So maybe the price will be 12.98. So the next on Tuesday, the NAV price will be 12.98. You multiply that by the number of shares, and that's how much money you would have. So it's not deducted directly from your amount; it's directed from the NAV price, the daily NAV that we publish. Oh, is it clear, or is it still? Yeah, I couldn't hear you, Dr. Mark.
It is clear. Thank you.
Okay. We can go back to the. I'm
It
sorry.
is clear. Thank you.
We can come back to the. Yeah, we can come back to it, inshallah, because it is a little bit, but it's not from the. It's from the total investment. It's calculated. So how does the structure of the mutual fund look like? How does it? Where does you heard Allied Asset Advisors, you heard Iman Fund. So what is the? How does the structure work? So you have shareholders, which are the investors. They're called shareholders. They own part of the fund. And then you have the mutual fund, which is where the money goes into this mutual fund. And there's a board of directors and trustees. These board of directors or trustees, we call them trustees in our company, in our case, they are elected by the shareholders. So the shareholders elect the board who oversee the fund. They are independent of the company, so they're independent of us. We're considered the investment advisor. Allied Asset Advisors is the investment advisor of the mutual fund. So this company here, this is a company, is the one that decides how to buy, when to sell of the stock, but it's an independent. So my salary comes from the investment advisor. Most of the expenses that occur come from the investment advisor. So the mutual fund is an independent. It has its own board, and the board just makes sure that we are following what we promised. So this is what the board of trustees' responsibility is. So the investment advisor is basically the portfolio manager who is picking the stocks on a daily basis or weekly basis. For example, myself and others on our team all will be working for the investment advisor. In our case, is the Allied Asset Advisor. The principal underwriter, this is the company. There's a distributor that takes the fund and makes it available to the retail, to all the individuals who are able to buy it. And this will be like through Fidelity or Charles Schwab or TD Ameritrade. So these companies, like if you see in your local area, TD Ameritrade or Charles Schwab, you can walk in there and buy Iman Fund because it's available through them. And the company that makes this available for us is considered an underwriter or a distributor. There's an administrator. The administrator oversees the performance of other companies that provide service to the fund, ensure that the fund operates compliant with applicable federal requirements. So basically, the documents you see that I just produced, the prospectus, there's others like annual report. There's other legal documents. They're provided to us by an administrator. In our case, we have U.S. Bank Fund Services that handles that. The transfer agent. So when you actually invest with us, you don't send us the money directly to us. You send it to our transfer agent, which is the U.S. Bank, and they hold the money. So we actually never hold the funds in. If you mail it to our office, we will then mail it to the bank under our name, but they handle it. They open the account. They make sure that they keep track of your information, with all the, web security. So if you called and asked for money, they go through the process of making sure that you are who you are. So that's all done at the transfer agent level, which is a third party. Then you have a custodian, which is what holds the stocks. So what we buy, so they will maintain and hold the assets of the fund. And then we have an independent public accountant, a CPA, that oversees to make sure that everything is correct regarding the fund. So this is how the fund structure is, and almost all the funds have these. Some might do things internally, and some will do them will outsource it. In our case, we outsourced it. So the investment, this is the Iman fund. So the Iman fund, Allied Asset Advisor is the investment advisor. So the 1%, the management fee that we said earlier, the expenses, they go to Allied Asset Advisors. The distributor is Quasar Distributors. It's a company, it's a subsidiary of U.S. Bank. Cohen and Company is the CPA firm. The transfer agent is U.S. Bank, Bancorp Fund Services. Custodian is U.S. Bank, and the legal counsel, Latham and Watkins. So in our board meetings, to help the board or the trustees manage the fund, we actually have a legal attorney who represents the fund, doesn't represent us, the investment advisor, represents the fund to make sure that we are doing what we promised to do, making sure that we are following the Islamic principles, that we are following the laws of the SEC, making sure, and they come from the legal point of view of that legal counsel. The next is the investment options. What kind of accounts? So that takes care of, I guess, the structure of the fund. So we want to move in now you have an idea of what a mutual fund looks like. It has objectives. So what kind of investment options are there? So there is a regular accounts. These regular accounts represent, for example, if you want to open one for yourself. Let's say Guidance University wants to establish an endowment and they want to open an investment account, they would open it under regular account. If you have you want to put money away for a grandchild, or you want to open a trust account, or you want to open a corporate account for your business, and it goes all under regular accounts, which means basically it's just a regular account that has no tax advantages. It's just a regular account you can set up any way you would like. Now, the second type of account is the IRA accounts. This is the account where you have your IRA, your Roth IRA, your SEP, which is the self-employed. So if you have a small company or you're a professional and you get paid a 1099, you can open a SEP. Or a simple IRA, which is for small companies that have about 100 employees, less than 100 employees, they can open a simple IRA. And there's one more that I must have cut off, which is the rollover IRA, which also goes underneath the IRA account. Those are if you have a 401k with your employer. So many people work in companies. The company has a sponsored retirement plan called a 401k or a 403b. There's different names for them, but let's use the most common name, 401k. They have a 401k and they work for that company. That fund that's there can be transferred to an IRA so that you have more control over that money. In a 401k, you're limited with what you can invest with. So many individuals have, when they leave the company, they have to move that money away from their employer, and they would consider it a rollover IRA. So they would move it from a 401k into a rollover IRA, and that would be under this IRA account that they would open. And then the third one is the Coverdell Educational Savings Account. This is an educational account that people can open for their children for educational purposes. You can put away about $2,000 a year. It goes tax-free. So there's some tax benefits for the Coverdell Educational Fund. So basically, there are three types of investment accounts that you can open. The regular account, the IRA account, which is a tax-advantaged account that has a traditional Roth, SEP, and simple IRAs. And in addition to that, you can have a 401k rollover, which is the company-sponsored account. And the final one is the Coverdell Educational, which is up to $2,000. So what does the application require? The application has I'm going to show you a sample of an application, but there are three parts to it that are required. So there's investor information, address. There's a cost basis, and we can go over that. But the most important, because of the federal laws, they have to know your customer. There's this KY. You have to know your customer, and there's 3 areas that you must have on the application, which is the investor information, basically name, date of birth, and social security. Then you have to have the address, and then they have to have a signature. Those are required on the application for us or for almost any financial institution. And I'm sure if many of you opened an account at any bank or any institution, those 3 things are required by the company. Now, the other parts, the cost basis method, the investment and distribution options, and telephone access, systematic, those are optional. They're for you to, I'll explain, for example, cost basis method. Cost basis method is, let's say you bought shares today in our company, and then you bought them again in 1 month, and then again in the 3rd month, and then 1 year later you wanted to sell. Obviously, each time you bought, the share price would be different. So you can decide which shares do you want to sell. And the most common and most, it's almost by default, is the average. So what we do is we take the average of the 3 purchases, and that's what becomes your cost basis, because that's important when you pay your taxes. When you pay your taxes, any capital gains that you have made, so let's say you made money, you would pay a tax on that to the IRS when you file your taxes. And I'm sure I think we're almost 15 days or 20 days away from April 15th, which is the deadline. So for us filing our taxes. So the cost basis would be a method for calculating your profit. We would give you that option. There is an option to choose like first in, last out, which means you put the money in first, that goes out last. That way you can maybe save on your money if the stock market went up. But I think that's someone who's more sophisticated, and you have to be very careful as to what you're asking for. But for the majority of us, the average cost basis, the average cost basis is what most people use. I use that, and most people use that. Investment and distribution options. This is if you have, when you have an IRA, for example, when you reach a regular traditional IRA, when you reach the age of 70 and a half, inshallah, may Allah give us umr, barakah in our lives. If you reach the age of 70 and a half, it's required that you withdraw money from your IRA. So when you withdraw your money from your IRA, you don't want to have to, there's a required minimum. So rather than do that, you can request us to send you that paycheck every quarter or every month, depending on what you want. The automatic investment plan, this is if you wanted to invest continuously. So let's say you wanted to invest in your IRA $400 a month. So we would just take $400 a month from your checking account or whatever account you tell us to withdraw it from. Telephone access, meaning that if you want to access your information, you would be able to do that through the phone. And I think next week we will have that online as well. So this covers the application, this is the most important part, is the investor information, address, and the signature. Those are the most important part, not only for our mutual fund, but I think for any financial institution. Especially now with these laws. The fees and expenses. SubhanAllah, Dr. Alqudah Sheikh mentioned to go over it, and I had put it again in the slide because it is a little bit difficult sometimes to see how you're calculating the expenses. So the 1% management fee, which goes to Allied Asset Advisors, and the 0.33 for a total of 1.33% a year. This is per year. That costs the fund. So what happens is, let's say we take a $1,000. You have a fund. You invest in it. There's expenses that come out. And how do we calculate the 1.33%? They take the 1.33% and divide it by the number of business days in a year, and they multiply it by the amount of the portfolio, how much money we have in assets. So basically what happens, if the stock market absolutely does not change, let's say we bought Apple, let's say we own 100 shares of Apple, and we bought 100 shares of Apple today, and tomorrow the same, or in 1 month, the same price is still there, $100 for 1,000 shares. I mean, 100 shares I'm sorry, 1,000 shares at $100. So let's say $100,000 portfolio. The 1.33% at the end of the 30 days, we would have the NAV, or the total portfolio would have lost 1.33 divided by 12, which is the prorated by the 12 months. So we would calculate it based on the whole assets and not the specifically your investment. So that's how it's calculated. It's when we give the performance, like the performance data, that's already minus the expenses. So that's net of expenses. So I hope that clarifies. I should have brought an example where it actually calculated, but even the calculation is somewhat difficult. But the 1%, those are the two numbers that you should be looking at, but they are the net of the assets, inshallah. Okay, Sharia compliant. So how do we or Muslims in general in the investment world decide or calculate or come up with a Sharia portfolio that's Sharia compliant? So in the banking industry, which is what Sheikh Ma'an went over, I guess, with guidance and La Riba and UIF and others. In the investment industry, it's somewhat more simplified. The scholars, I think, Sheikh Mufti Taqi Usmani, who just I think was injured, but he was a chairman of IOFI, and him and other scholars came up with some guideline for Muslims to follow when it comes to Sharia. So the first first process to make a Sharia compliant stock, and then after you have the Sharia compliant stock, you'll end up having a Sharia compliant mutual fund, is you must eliminate any non-Sharia compliant or non-permissible products or services that are being sold in by the company as a main part of their industry. And they came up with a percentage of the 5%. It's not meant to be exact 5%, for example. There's maybe some leeway, because most companies, it's hard to define this non-permissible products and services. But the most important thing to look at is it cannot be part of their core business, which is alcohol, pork products, weapons, adult entertainment, gambling, and of course, the most important is interest. That they cannot be in those industries. So any company that is in that industry is automatically removed from the pool of funds that you're allowed to buy. So let's say there are about 3,000, 4,000 companies or 5,000 companies in the U.S. that you would want to buy. You would eliminate these companies that are partaking in this type of business, and then you would remove them, and you would look at the other companies as a way to have them permissible. So that's the first step that we must do, is to eliminate that. Now, how is it eliminated, and how does the Sharia board or Sharia get involved in this? And I'm going to talk about that as well. So most of this is done by most companies are already categorized. So there are actually like there's Ideal Rating. There's a company out of San Francisco. There's Dow Jones, I believe, does this. A lot of companies have what they call they have a screening process, which is negative screening, which basically means you tell it parameters. I don't want companies without alcohol. You check it. No pork. You check it. No weapons, you check it, and then it gives you the list of the companies that's left over. So you have a pool of companies that don't have this in their core business. So this does not mean you're finished. It just means that's your starting point. So you eliminate a lot of the companies that meet this criteria. The second criteria for the Islamic for the Sharia compliant is I'm sorry if this is not clear. Is the ratio. Interest is haram, it's forbidden in its totality, but the scholars have come together to come to a somewhat understanding to provide Muslims a way to partake in these investments. One time, and I remember when a couple of years ago when I was talking to friends, they asked me, does this mean that we can invest in a local store? And if you have a 7-Eleven or a gas station and you want to partake, you want to be a partner, and as long as the percentages work out, does that make it halal? And the answer to that, the sheikh would be better to do that. But what we're talking about is it's not permissible. This is only permissible for publicly traded companies, where there's a difference between being a partner and being a shareholder. Because in these companies, you own a share. You don't have any power to make decisions. You have no power to, you have no sway. You are one of millions and hundreds of millions of people, individuals who are investing in this company. You don't have you have no decision. You have no power to make any difference. So this is the only way this becomes permissible if there are no companies to invest in. So there's no Sharia compliant, 100% Sharia compliant investment. So the scholars have given us a permission to have some type of our funds invested. And we have to follow those two criteria. So the first screening was the 5%. And the second screening, which is to look at the interest or total debt that the company borrowed. So how much money did they borrow? And looking at it as a market capitalization. So there's a formula to that. And it has to be less than 30%. The cash and interest-bearing securities has to be less than 30% of the market capitalization. And the third account is the account receivable divided by market cap is less than 50%. This third one is actually very rare. Do you have a company that goes over this? The two that you must be, that are very common and looked at is the total debt. How much money did the company borrow? Or how much cash it has. For example, Apple has a huge amount of cash. So how much of that cash is sitting in interest-bearing accounts? And we have to look at that in treasuries. So that's what we have to look at, and it has to be less than 30% of the market capitalization. So this is the formula. So where does the board come in? So when does the Sharia scholar or the sheikh can come in and say, because these are all formulas that are produced by, you can almost say, by computers. They look at the financial statement, they extract the numbers, and you come up with a number. Because what happens is the stock market fluctuates. So it fluctuates, it goes down. So if let's say if a company has a debt of 20%, and the market goes down 10%, right away you have maybe that debt now exceeds the 30%. What do you do? Let's say it's at 30% or 31%. So when do you sell that? So there's the scholar, the Sharia board or the Sharia scholar on board has to make a decision or in consultation with a portfolio manager. So this is a working together because there's a benefit to the shareholder. So they look, should we sell today? If the requirement is, so there's a window of an opportunity. So let's say you come out of Sharia, you're out of Sharia compliance. Now you have to go back in Sharia compliant. So the portfolio manager and the Sharia scholar must decide when to sell that stock without hurting or without causing a loss to the investor or causing too much of a loss. I should say that. Not loss, because there is going to be a loss, but not to cause too much harm. So that decision as to when to sell is in conjunction between the portfolio manager and a Sharia scholar. That's who decides when that is. Now, in our case, in our company, we have a policy to, when we buy companies, we try to buy them between 12% to about 18%. So that's the range when we're looking at a company. When we start, that's like we say, that's when we say buy company. When you say hold, we say between 15 and 22%. 15 to 22% is when we hold the company. We don't buy any more shares of that company, and we're just holding it and seeing where it goes. And if it goes between 18% and 25%, there's an overlap because it depends. There's 18 to 25% is what we call the exit plan. This is the range where we have to begin to exit the stock. So let's say we own Apple, and Apple now reached 18, 19%. So we have to start looking for an opportunity to sell. Why do we have to look for an opportunity, not sell right away? Because the stock market goes ups and down. We don't want to be selling. Maybe there was bad news maybe there was a tweet or something that caused the price to go down, and a couple of days later it'll come back up. So we'll wait a couple of days and keep an eye out so that we exit when it's in the best interest of the shareholder. So this is one area of where the scholar comes in, and I want to so this is one area that needs to be addressed cannot be addressed by a computer, cannot be addressed by a portfolio by himself. This requires a team between the portfolio and the scholar. How about, let's say, an example, mistakes do happen, and the stock actually went and became non-permissible, out of compliance. It became non-Sharia compliant. What do you do with that gain? So the company sold, but there was a gain. So who pays for that? Obviously, in our case, because we live in the U.S., there's laws. The fund cannot pay it, but the advisor might pay it on its behalf. So this is a separate issue. So it depends on who has to pay. There's a penalty if there's any cause. Let's say that there was interest incurred. Either you gained interest or you lost interest, or you had to pay the interest. This has to be who's responsible for that. So in the scholars would always put the burden on the wakil, which is what the advisor is the investment advisor, which is us, who have to take responsibility for this. So to protect the fund. Okay, so hopefully, inshallah, I covered a little bit of the Sharia component of that. And then, okay, this is very quick. The fund for us is overseen by the Iman Fund trustees, there are three actually in our fund. One of them is Sheikh Abdullah Idris. He's currently in Canada. And we have two lay leaders, Dr. Qudaymi, he's the chairman of the CARE Chicago, and then Dr. Qaisruddin, he was the president of the MCC Masjid in the CIGC. So those are independent board members of the fund. And then from the Allied Asset Advisors, I did not mention this, but we are owned by the North American Islamic Trust, which is an Islamic organization, a Waqf program, a Waqf institution that was established in 1973. It has about 200 masajid in it, and we have members on that board. One of them would be Sheikh Muzammil Siddiqui and others. All of this is reviewed. What I just mentioned is reviewed quarterly. Every quarter it's reviewed by them. We have a quarterly meeting with the trustees every quarter, no exceptions. With the NATE board, maybe one quarter might be delayed, but the fund, it has to be by law. We have to meet every quarter. So I think this covers most of the topics, and inshallah we'll be able to answer any questions if you have. I don't know if I finished a little early or not, but inshallah khair.
Jazakallah khair, Dr. Mohamad, barakallah feek. And I forgot to say that Dr. Mohamad Nasir was one of our experts, one of our speakers in MJ conference. He was talking about a mutual fund as well. Jazakallah khair for your time and for your effort. Let me just ask you again, and I would love to hear a very simple answer. I invested $1,000 in the beginning of 2019 with the Iman Fund. So at the end of 2019, the net profit became $500. So the 1,000 became $1,500 toward the end of 2019. Let's say that you charge only 1%. Will you be charging me $150 or $100?
Okay.
Sorry.
Do you mind if can I put it in a little bit? Yeah. If you let me change it just a little bit, or if it doesn't fit, I'll come back to it. Let's say you opened an account today with us on March 24th, March 25th, and you put in the account $1,000. Okay. At the end of December 31st, you opened your account and there was $1,500 in it. The statement had $1,500. The 1% you would receive, if you withdrew the money, you would draw $1,500. The 1% and the percentage that we take has already been deducted on a daily basis between today and the time you take the money out. So whatever you have in the account, any money that you have in the account, or any money, or the NAV price. Because let's say maybe a better, if you let me even extrapolate that, if you bought 100 shares at $10, that's $1,000, and then at the end of the year you still have 100 shares, but the price is now $15, so it's 1,500. You would receive $1,500. You would receive all of it, because the price, the NAV price, that went from $10 to 15, has already deducted the expenses. So the expenses is already deducted from it when they calculate the NAV, which is the net asset value of the fund.
So in a very simple language,
I hope that
yeah, you deduct from the principal and the profit, or from the principal
it's
and
from the principal and the profit.
Oh, I see.
Yeah.
That's clear. The floor actually is open for
it's
our
the total.
participants. Yeah. If you prefer to speak, Dr. Mohamad Nasir, please raise your hand. If you prefer to type your question, go to the chat bar in the bottom of the page, and just type your question. It's up to you. If you want to talk, please raise your hand, and I will turn your microphone on. Until here is Nadir. تفضل يا نادر. Nadir actually is one of our students in the Islamic finance. تفضل يا نادر. نادر تفضل.
I think he.
Assalamu alaikum. Can you hear me now?
Yes, we can.
Yeah.
Okay. Assalamu alaikum. Barakallah fiki, Dr. Mohamad, al presentation. Actually, I am here with my wife, Nadia, as well, and we both have questions. So do you want to start with the question?
Okay, so the first question is which standard that you referenced when you mentioned the 3 ratios? I saw the first 2 with I think the 30% are consistent with what I've seen in IOFI, but I haven't seen the accounts receivable over market cap less than 50% documented before. So is that also an IOFI standard, or is that another?
It's an IOFI standard.
IOFI, okay. And then this is a question for Dr. Iman. So, or I mean, maybe for both of you, but it's in reference to the example, Brother Mohamad, that you gave about if you were a partner, that those percentages are not, you know, that's not the intention of the percentages. The percentages are the intention when you are a shareholder. And so, Dr. Iman, my question, I guess, for you from the lecture on Monday, we talked about, you know, mudaraba, and I guess I thought, or my understanding is mudaraba is sort of like a stock investment, because you have a person that's put in the capital and you have another person that's doing the work. And so at what point is that true that stocks are like mudaraba? And then if so, then where's the line drawn? Because you could be like a shareholder that owns, like, you know, 10% of a stock, and maybe you do have some control, you know, or you could or it could be a private mudaraba, and like, where's that line drawn between when you can use these ratios versus when you're a partner and you can't use these ratios and you have to be doing something that's really purely halal? Does that make sense?
Yes, sir.
Yeah, Doctor. Yeah, I'm talking about publicly traded companies. So any private dealings or private contracts, that doesn't fulfill that. We're talking about publicly traded companies, which means there are probably, you know, there are hundreds of millions of shares outstanding. So you don't own 10%, not even 1%. You own less than 1%. So there's 2 different contracts. One, this is between owning a share in a publicly traded company where the shares are outstanding, not a privately held company or a privately held contract. That's my understanding of the Sharia. These numbers I gave are specifically for publicly traded companies.
But then I guess, like, the question is that, like, I mean, obviously this would be a high net worth individual, but an individual could own a substantial portion of an investment, and they could, or even an institutional investor, like, you know, could pool, like, Sharia portfolio could pool all of their investors' money and be a fairly substantial investor in one of these stocks. So, like, let's say that someone, a wealthy individual, owns 10% of a stock on a publicly traded company, or there's a Muslim institutional investor investing on behalf of people. Like, at what point do you say, you know, you own enough stock that you actually do have a voice in the shareholders meeting, and therefore, you know, like, do the rules change, I guess, when you become someone that actually can make an impact, when, if you're, you know, if you're a shareholder that actually has a say?
My understanding is if you have a say, then you should attend the meetings and voice your objection to the purchases of, you know, of things that are not permissible, or to stop the participating in interest-bearing transactions, if that is true.
Okay, thank you.
The ultimate goal, I mean, we talk about these numbers, the ultimate goal is to reach to zero. I mean, that's my, you know, our understanding is we would like the companies to promote to get out of these sin businesses and get out of interest and have a purely halal, purely Sharia compliant companies, which will end up benefiting humanity ultimately.
Let me, Dr. Mohamad answer Nadia's question, because she is one of our students, and I understand very well what is she referring to. Yes, Nadia, you are correct. This model actually is a mudaraba one, where the investor actually is the financier, and Iman Fund actually is the operator or the director or the manager of the business. If you want to go with the ideal situation of the mudaraba, Iman Fund and other like Islamic Mutual Fund are not supposed to charge certain percentage from the principal and the profit as well, or from the principal and the loss as well. Very simple example. They charge 1%. I invested $1,000. The $1,000 toward the end of the year became $1,500. If you want to go with the ideal situation, they're supposed to identify their commission or service fees as a certain percentage of the actual profit. Like they're supposed to take maybe 10, 15, 20, whatever they want from the $500 in our example, not from the $1,500. However, I did actually discuss this issue with several companies a while ago with the Azad Fund, Brother Bashar Qasim, and he said, this is the law in the US. I mean, it's not our call whether to go with the pure percentage of the profit. No, it has to be done this way. So I just want to hear from Dr. Mohamad Nasir that yes, it is still the same situation, that it's not your call to mandate or to charge certain percentage from the commission. It has to be from the total, whether the total actually is a principal plus profit or principal minus loss. Is that the case still?
Yeah, it is the case. We charge 1% of whatever amount there is in there. If it goes up, it's we're charging 1%, and if it goes down, we're charging 1%.
Okay, here is the ruling. Back in 2005, our Fiqh Council, AMJA, the Assembly of Muslim Jurists of America, we did actually discuss this particular technical point, and we said, since this is something, number one, unavoidable, it's not like within our control to decide how to charge our customers, and number two, the gharar or the ambiguity or the misrepresentation is to the minimum, because when they ask for 1%, 2%, whatever the percentage might be, when they ask to charge as a commission from the principal and the profit, we both know, the investor and like the operator, the Iman Fund, we know almost how much will be the total amount is, because we know the principal, and approximately we know that we will be making, let's say, 4 or 5%. So the gharar or the ambiguity is not that something significant. We can tolerate that and just move on. Yet this is not the ideal situation. And I wish I answered your question, yeah, Nadia. Is this what you were referring to?
Yes, thank you. Shukran.
Actually, I'd like to thank you also, Doctor. It was good to know this, yani, inshallah.
Okay, the floor is open for question and answer. Any of our participants, if you want to talk live, please let me know. Otherwise, just type your question in the chat bar. Right. Until we receive more questions, Dr. Mohamad, if you decide as a general manager, okay, or financial advisor, that you want to invest, okay, you want to invest based on your own understanding in ExxonMobil, okay, and your Sharia advisory board said no, the haram percentage actually is above the average, so do not invest in ExxonMobil. On the real life, on the daily operation, who makes a decision when you say yes and they say no? Do they like override your decision as a board or not?
Yeah, no. The board. This, when we have specific questions, we ask actually a Sheikh Muzammil Siddiqui. He responds and we follow it. And there might be debate. Might be some discussion, clarifications. Sometimes the question is not clear or the background is not there. Once the information is given and the scholar says he comes out with a statement, then we have to follow it. Let's say we were told to sell. So the question, let's say this was not a good opportunity. The portfolio might go back and say, can we have 1 week to sell? Now, if the scholar says no, then he will sell right away. If he says yes, you have a week to sell, then you can sell it within a week. So there's the ultimate decision is to the scholar, with with information coming from the portfolio manager.
The other thing, like usually mutual fund companies or Islamic, or finance institutes in general, they have a Sharia advisory and supervisory board from one side, and they have a Sharia audit. And the main difference between the two is that the Sharia advisory board is the one actually who is authorized to set principles, guidelines, restrictions. Actually, it is the legislative, branch or body of the company. Now, the audit one is way different. The audit one is the one who makes sure that all those principles and guidelines are implemented accordingly. Do you have such, differentiation in your business? Do you have Sharia audit done by a third independent party to make sure that those principles are actually in effect and they are, abide by?
Yeah. So every year we discuss this in our board. Every year, almost every year, if not more than 1 year, should we have an audit or should we not have an audit, and why? If not, then why not? So far, so we are discussing it. Currently, we don't have a Sharia audit. We are considering it. There's multiple factors that are considered, which is the basically the cost of one, and second is who is going to conduct the audit. So we were in discussion with multiple individuals, and this was an issue: is who would actually conduct it, and then who would have historical. I mean, he would have a basis in the U.S. I know, like for example, Azad, for example, does an audit. But they do an audit not on their mutual fund. I think they do it only on their separately managed accounts. Okay. So but this is under discussion, and we're pushing for it, inshallah. And hopefully, I think within a short period of time, we're gonna, start having like in this, in 1 year have an internal audit, and then the following year have a full Sharia audit. But this is in discussion as of right now.
Would you please answer the question from Bakr Assaf? You can see it maybe in the chat box.
Yeah. The question is the 30% group threshold triggered by software every X period, or is it manually reviewed by the fund manager? And if so, how periodically? Yeah. So the 30% threshold is this by software. So these data that we receive come from financial statements by the company itself. These companies usually produce the numbers every quarter. This is where a Sharia scholar would come in. In our case, we try never to reach 30%. We actually rarely I get to see it every 30 days, and we never even come, the highest we've been up to is 25%. So we try never to reach that 30% level where you're on the borderline of being out of permissibility. So just to answer your question, it's reviewed continuously by the portfolio manager, but it's downloaded, or I'm using the word you use, but it's extracted from the Edgar reports every month, where it's being looked at and monitored so that it doesn't reach the 30% threshold. So that gives, that's the 1 month scenario, unless an incident happens. And what I mean by an incident could be a huge drop in the market, or a huge change in the market. So, for example, in the month of December, or in the fourth quarter of 2018, we had a drop in the market that was tremendous. It's considered a large drop. Then it would be reviewed on a every other day. It doesn't take much effort, but there is some effort that requires, and the numbers will be looked at then. So during that time, that was an exception. But usually, I would say every 30 days, when we have the full statement of transactions.
Okay, and I do have a question.
Hopefully,
I know that practicing Muslims do not go by profitability to make a decision. Rather, they go by permissibility. So they do not compare the profit that they make out of having an investment account versus the profit that they make out of having an Islamic Mutual Fund one. But if you want to make a very quick comparison, someone opened a traditional riba-based saving account with Bank of America, for example, okay? And somebody else, has done the same with Iman Fund. Toward the end of the year, profitability-wise, is it the same? Are you more? Are you less? Are you within the average?
So I would say that for the most part, we are similar. I can actually, I would like to give, since we're talking about performance, if I can give a actual number. So there's actually
please.
They're almost identical for the most part. They're not much different. There was one Singaporean company, mutual fund, that did a study on Islamic finance, Islamic halal mutual funds, and halal and non-Sharia compliant mutual funds. And over certain periods, along large periods, the halal mutual fund outperformed the non-Sharia compliant. So I would not say that the Sharia would hinder it. I'm going to bring an example. It's a competitor of ours, Amana Mutual Fund. They actually did very well for the 10-year period of the 2000s, and actually they outperformed the market in general, especially when the market went down. So there are glimpses here and there. I think we have. If I was trying to pull our performance for the period through, let's say 2018, I think we did better than S&P 500. So there are you will not pay more. You will not lose money because you're in Sharia compliant. The biggest issue with Sharia compliant funds is products, not enough products. That is probably the biggest concern. I think from the advantage of performance, I think people will be it's competitive, if not more competitive than the general market.
Okay, generally speaking, can I make like 4% net profit, 5% net profit overall? Is it
overall? Okay.
How much I can
so,
make?
For example, over a 10-year period, in the last 10 years, the last 10 years have been good. You would make 12.33% a year. In our fund,
net profit,
you would have had 12.3. I'm sorry?
Yeah, net profit, 12.5%.
Net profit, 12.33%. That means if you invested $10,000 in 2008, December 31st, 2008, you would have $31,972. But the market in general went up that. I mean, that was a good 10 years. You know, that was right after the drop in the market. So this was a good 10-year period. But if you had invested $10,000 in 2008, at the end of 2008, at the end of 2018, you would have had $31,972 to the penny.
طيب أخي, do you make it clear for your investors that you do not guarantee their profit? This is from one
Yes.
side. From
So if you look at any documents, we have a disclosure like that prospectus that this is, you know, that there is a risk to your investment. So there's on our fact sheet, on all our documents, we have important disclosure, you know, that says basically fund holdings or sector allocations are subject to any, you know, to risk. Mutual fund investing involves risk. Principal loss is possible. So that's written down on all our documents that they know that the money going in is there's a potential for loss. The recommendation I give, if you are looking for short-term investment, then this is not the best thing. This is for people who are trying to invest for the long term. If you're looking for 1 year, like people come and they say they save $25,000 for their house or $35,000 to buy a home, then I would not recommend putting that money in a mutual fund or any stock market, in the stock market in general.
Do regular mutual fund companies like non-Islamic ones do the same or have the same, like, you know, disclosure that they do not guarantee the principal? Or
everybody has the same disclosure.
Oh, the same.
Practically 99% is exactly like the other disclosures, all the same.
Do you have?
They're all regulated by the same.
Do you have non-Muslim investors in your ethical, you know, socially responsible?
We've had Muslim investors, especially when you there's a lot of we're actually now engaged. Now the Sharia compliant part is growing a little bit into the ESG, which is the environmental and sustainable governance. So we've actually had some work done with this, let's say, interfaith investment, like the Catholics and the Methodists. They have something similar to us in their investments, where they try to stay away from alcohol and gambling and casinos, not pork, maybe not interest, but the other parts they are into not buying those type of companies. We've had some of their people invest, but the majority of our investors are actually, we don't know who they are, because they buy our fund through third parties. So we don't know who they are. Like if somebody goes to Fidelity or Charles Schwab and buy our fund, we know that someone bought, but we don't know who that person is.
We have from Abdisa Tufa. How is your fee as compared to conventional mutual funds?
So our fee, I think we're a little bit higher in our fee than the conventional mutual funds in general. For the size, I mean, we are a $120 million fund. I think for our size, we're on average for the size. But if you took the whole market, you know, some of them have billions of dollars, so their expenses are much lower. So in the general, we're a little bit higher, but for the size, we're on average, if not a little bit less below average. And as the fund grows, that number goes down every year. Inshallah.
Can you tell us about hedge fund? What does it mean? Do you do it? Why it is more risky and more profitable?
I'm sorry, for each
hedge fund.
Oh, the hedge fund. So the hedge fund is so most people cannot invest in a hedge fund. Most retail investors cannot invest in a hedge fund. It's for those accredited investors that I believe the sister mentioned, and We mentioned earlier that there are individuals who are high net worth, or Dr. Mohamad, you mentioned, that can invest in hedge funds. But they usually, they might, each hedge fund has its own investment objective and strategy. But many of them short a stock, meaning they bet that the stock, they not bet, but they're betting that the stock will go down, so they sell it without owning it. It's a process. So they're leveraging debt. They're leveraging a lot of their investment. It's much more high risk. That's why it's not available for the average investor. It's only available to the accredited investor. But it's riskier. But obviously, with risk, some people have rewards. But there's the Sharia component. I think it would be hard for someone to make a Sharia compliant hedge fund because of the they have to short a stock, and they short stocks and they leverage it. So there's a lot of leveraging and shorting, and short-term trading with hedge funds. But each hedge fund has its own strategy. So I would have to look at what their objectives are in a specific hedge fund.
So
but, they're risky.
The short sale does not, necessarily involve full ownership. Like when you short sell something, does it mean that you do not own it? You do not take any risk or liability before you sell it back?
My understanding of the short sale is that you sell something you promise to buy in the future. So I sell one share of this company today, and I promise to deliver it at a future date. Hopefully it goes down because I will get it for cheaper to give it to you, to deliver to you. And if the price goes up, that means I have to pay more for it, and then I lose. That would mean, it's not part of our company, so I would have to actually kind of review exactly. But it's something like you're selling something that you don't have. You're betting for it to go down because the price will be cheaper at that time. It's very sophisticated. It's for people who are in the trading business, not for the retail. Most of our business is for the average consumer, not the individuals who are trading.
Yeah. We have a question from Dr. Mohamad. Would you please?
The question is, if you know what you're doing, you can buy and sell mutual funds in a short term. What are the drawbacks of this strategy in your view? So, for us, a mutual fund, we discourage buying and selling the fund in a short period of time. Our objective is for long-term investment, so we encourage our shareholders to be in for the long term. Long term is relative. Some people may think 3 months is long term. Some might think longer. But we don't want to be market timing is a better word. We discourage market timing. Now, for someone who, if somebody understands what they're doing, and they rather than trade stocks, they trade funds. I mean, I have, that's into a different type of investment. I'm not sure I can't give advice on because they might lose money. There's traders tend to make some money and lose a lot of money. So I would refrain from answering on that question only because there's a high risk on that strategy. But you can buy and sell mutual funds, on a consistent basis. But I'm not sure, how that would work out. We actually promote that, not to try to time the market, not to wait when the market is low and then buy and then wait till it's high and sell, because nobody knows where this market goes. It fluctuates. In December it was going out of business. The market looked like it was in bad shape, and then since January till now, which is almost 10 weeks, the market is up 17%. So it's hard to judge. So the best thing for an individual is to invest over the long term for the long term. The strategy to buy and sell, that becomes a different type of trade. It's a trader, not necessarily an investor. So there'll be a difference in that, inshallah. I'm sorry, Dr. Mohamad, if I didn't answer your question and it's on purpose. I don't, maybe we can talk separately on this.
Right. Apparently, we do not have any further questions. I just want to make sure we have Toha, Moshe. Oh, here we go. Abdisa, go ahead. Abdisa actually is one of our students as well. Go ahead, Abdisa.
Yes.
Abdisa, go ahead.
Can you hear me now?
Yes.
So instead of investing in a mana fund, what if I go online, for example, buy a stock from Boeing, which manufacture aircraft, or maybe from Microsoft stock? So someone can do that. What do they have to come to you? Because you mentioned earlier.
Yes.
Go ahead.
Well, yeah, that's a very good and legitimate question. So, yes, you can buy stocks directly through a brokerage. You don't need to go through us or any other company to buy it. So why mutual funds? Most individuals are unable to monitor their investments on a daily basis. So when you invest through a mutual fund, you're relying on someone to watch your investment over time. Does that mean they're going to make you more money or less, make you more money? Probably. That is a hard question to answer. But there's someone monitoring and assessing your investment on a daily basis. The second, and really the more important, is individuals tend not to be able to buy. They will not be able to diversify their investment if they buy directly, because they don't have the funds available to buy, to diversify, for example, into 100 companies, to make sure that no investment is over 5% of their portfolio. So that if there's an Arthur Andersen or I don't know, maybe, or Enron, where they go bankrupt, or General Motors, that just happened a few years back, you would lose, a big portion of your company. So in a mutual fund, we have guidelines and rules that we follow. Like, you will not see more than 5-6% of the investment in any single company. We will not own too much of one company, percentage-wise, of that company. So there's a lot of diversification that happens. It is difficult for it to happen with an individual, unless he's a high net worth individual, and then yes, some of them choose not to. But believe it or not, even high net worth individuals who are passive end up investing in mutual funds or have an advisor create a portfolio for them. So there is a risk when you are trying to pick 2, 3, 4, 5 companies. There is an issue with monitoring them. There's another issue with cost. With mutual fund, the majority of the time, there's very little cost to you as an investor. I'm not speaking about but I'm talking about the transactional cost. Usually the companies, let's say Charles Schwab or TD Ameritrade, will charge you a one-time fee when you buy the mutual fund, but when you go back and buy again, they will not. There's no charges. When you're dealing with stocks, you're paying for them. I know there's a new company called Robinhood, I think, that doesn't charge, which, these things are coming out, or there's now low fees. I think E-Trade, $7.95, but there's still that cost. So the question is, you have to measure: do I have enough funds to diversify? Do I have the time to monitor my investment? And if if you're able to monitor your investment and you have enough funds, then yes, maybe you can buy your own individual stocks and monitor them yourself as an individual investor. And people do that. That means more of an active investor. And we're not all active investors. Some of them are passive.
Well, Karim, as you are coming toward the end of the class, it's now almost 1 hour and a half. On behalf of Alqudah University Guidance College, on behalf of myself and my students and all the attendees, I would like to thank you so much. Jazakallah khairan for your time, for your effort, for your experience.
Thank you, Dr. Mahan.
We were actually enlightened.
Thank you for all the work you're doing, mashallah. Thank you.
And in Amja as well, and we look forward, inshallah, for more sessions, inshallah, to benefit from your knowledge and your expertise. Jazakumullah khairan all. Thanks to everybody for joining our class. And one more time, next week, inshallah, we'll be having a team from Guidance Residential. The CEO and some other top executives will be representing Guidance Residential, their model and their contract, and why they consider themselves Sharia compliant. So please join us next week. Jazakumullah khairan all. Assalamu alaikum wa rahmatullahi wa barakatuh.
عليكم السلام ورحمة الله دكتور.